So what if I told you that the most dangerous artificial intelligence disruption isn't actually happening in, like, some Silicon Valley coding lab?
I mean, I'd say that's where everyone assumes it's happening, right?
Exactly. We usually picture AI, taking over a factory floor or generating movie scripts in seconds. Loud, obvious stuff.
Right. The stuff that's right in front of our faces.
Yeah. But instead, it's quietly freezing billions of dollars inside this secret trillion-dollar VIP room on Wall Street.
Which is wild. Because it's comforting to see the machinery of change in action.
Totally.
Like when we can clearly see the cause and effect, we feel like we understand the risk. But the reality playing out right now is just this fascinating contradiction.
Right.
The bleeding edge of tomorrow's technology is creating a very traditional, old-school financial panic. And it's happening completely in the shadows.
It really is. And, well, welcome to today's Deep Dive. We are so glad you're joining us for this one.
It's a great topic today.
Yeah, so our mission for this deep dive is to unpack this hidden trillion-dollar engine. It's a space known as the private credit market.
A market most people have never even heard of.
Exactly. And we're going to trace this incredibly unexpected domino effect between artificial intelligence and these private loans.
And we're going to decode what this means for the broader financial system, too.
Right, and more importantly, what it means for your own personal strategy. Because, I mean, it is genuinely wild that tech developments out west are causing literal tremors in these obscure financial vehicles.
Vehicles that, like you said, most everyday investors never even look at.
Yeah, it's just crazy.
It's the ultimate financial butterfly effect. A programmer writes a new algorithmic model in California, and suddenly a multi-billion-dollar loan portfolio in New York just starts flashing red.
Flashing bright red. So to really understand why this matters to you, we first have to define what this hidden market actually is.
Right, we have to set the stage.
Because under normal circumstances, retail investors, everyday people buying stocks or mutual funds for their retirement accounts, they are completely locked out of it.
Totally locked out. This
No.
market is built exclusively for high net worth individuals and massive institutional investors.
Like pension funds or sovereign wealth funds.
Exactly. And the core appeal for them is yield. In a world where standard public bonds might not pay a return that really beats inflation, these wealthy investors are looking for more.
They want that higher interest rate.
Right, so they're willing to lock their money up to get it. They essentially bypass traditional banks altogether and lend directly to private companies.
But the catch, and this is a big catch, is that these loans are deeply illiquid.
Very illiquid.
Like you can't just log into your brokerage app and sell your private credit position tomorrow. Not like you could with a share of, say, Apple stock.
No, absolutely not. Your money is locked in for 5, maybe even 7 years.
Wow, 7 years.
Yeah. And we should be clear, this is not some niche boutique little club.
No, the total private credit market is valued at more than $1 trillion.
It's staggering. It's a massive amount of capital operating completely outside the highly regulated public banking system.
Which, brings up a very natural question.
Why should the average person care about a playground built for billionaires?
Exactly. And the analogy that I think perfectly captures this is think of a VIP high roller room at a massive casino.
Oh, I like that.
Right. Because usually, everyday folks aren't allowed past the velvet rope. They're out on the main floor playing the penny slots, and honestly, they don't care what happens behind those doors.
They're just doing their own thing.
Exactly. The high rollers are playing their own high-stakes games. But, and here's the kicker, if that VIP room catches fire, the smoke doesn't respect the velvet rope.
It's going to seep out.
Right. It seeps under the door, it fills the entire casino, and suddenly everyone on the main floor is choking.
That is a perfect visualization.
You really need to pay attention to this trillion-dollar market because, well, the smoke is already starting to billow out.
It really is. And you would typically expect a private credit crisis to start with, I don't know, bad commercial real estate deal.
Yeah, or like a localized collapse in manufacturing or something.
Exactly. But the distress in this VIP room is being triggered by a completely unexpected spark. And that spark is artificial intelligence.
Which just feels entirely disconnected.
Right.
I mean, when I was looking at the mechanics of this, I was shocked to see that the private credit market is actually heavily tied to the software industry.
It's hugely tied to it. Private equity firms absolutely love buying software companies.
And they use these private credit loans to fund those massive acquisitions, right?
Yes, exactly. Because historically, software companies were viewed as incredibly safe bets for these massive illiquid loans.
Why is that?
The magic phrase was recurring revenue.
Ah, right. Subscriptions.
Precisely. If you build an enterprise software platform for, say, human resources or inventory management, companies buy a subscription.
And they just pay you every single month.
Year after year, like clockwork. That reliable, sticky cash flow is the exact profile you want when you're trying to pay off a massive private loan.
Right. But then enter generative AI.
Yeah, the game changer.
Suddenly, the entire foundation of that sticky enterprise software is trembling.
Because investors are looking at these traditional software companies and realizing they might be, well, entirely obsolete in a few years.
Yeah. I mean, why would a mid-sized logistics company pay $100,000 a year for some clunky inventory software suite?
When they can just deploy an AI agent to build a custom automated solution for a fraction of the cost.
Exactly. It's a no-brainer.
And that realization has caused public software stocks to fall pretty dramatically. The market is pricing in the very real threat that legacy enterprise software is going to get eaten alive by AI automation.
Okay, wait. I am struggling to see the bridge here, though. Got to push back on the mechanics.
Sure, go for it.
If these private credit funds hold illiquid loans to private companies, meaning they aren't traded on a public stock exchange minute by minute, why does a public panic about AI matter today?
That's a great question.
Like, how does the psychology of a public stock dropping drag down the value of a private locked-in loan?
It all comes down to this terrifying accounting process called mark-to-market.
Okay, mark to market.
Right. Even though the loan is private and the money is locked up, the fund managers still have to send out quarterly reports to their wealthy investors.
We show them what their portfolio is worth.
Exactly. They have to estimate what that loan portfolio is worth today.
Yeah.
And to do that, they have to find a comparable public company.
Oh, I see.
So when public software stocks tank because of AI fears, the accountants at the private credit funds have no choice.
They have to adjust their numbers?
Yes. They look at their books and say, well, if that massive public software company is suddenly worth 30% less, the private software company we lent money to is probably worth 30% less too.
Wow. So the perceived value of the private credit fund drops, even if the private software company hasn't actually missed a single loan payment yet.
Precisely. It's a psychological contagion that forces a mathematical markdown.
That is why.
And that markdown hurts the overall value of the fund, which then sparks panic among the investors. It basically creates the conditions for a severe downward spiral.
And we're already seeing major Wall Street titans sounding the alarm on this, right?
Oh, absolutely. David Solomon, the CEO of Goldman Sachs, he actually dedicated a significant portion of his annual shareholder letter to this exact vulnerability.
Yeah, I saw that. He specifically called out the poor underwriting quality in private credit and its heavy exposure to software that could be disrupted by AI.
Yes, he did.
But the phrase that really jumped out to me was his warning that the credit cycle has not been repealed.
Which is a very polite institutional way of telling investors to brace for impact.
Yeah, buckle up.
To really understand what he means by poor underwriting quality, you have to look back at when these loans were actually signed.
Right, like 3 or 4 years ago.
Exactly. Back then, money was incredibly cheap. Interest rates were basically at zero.
So private credit funds were just competing aggressively to hand out cash.
They were throwing money at these companies. And to win those deals, they lowered their standards. They didn't build in strong protections.
And more importantly, they didn't price in the risk of artificial intelligence.
Because generative AI wasn't dominating the conversation yet.
Right. They underwrote these loans, assuming the software industry was invincible.
They assumed the recurring revenue would last forever. So Solomon is basically reminding everyone that the credit cycle, that natural rhythm where debt piles up and economic shock hits and companies start defaulting, it's still very much alive.
Yeah. Just because these loans are hiding in a private VIP room doesn't mean they're immune to the laws of financial gravity.
Exactly. Companies are going to default.
And this downward spiral isn't just theoretical anymore, is it? We aren't just parsing cautious letters from bank CEOs.
No, it's happening.
The warning lights in the financial sector are actively flashing red. It's forcing massive financial institutions to slam on the brakes. We're seeing incredibly alarming concrete examples of private credit firms struggling to survive this exact panic right now.
The theoretical risk has crossed over into hard financial reality.
Yeah.
Several publicly traded private credit firms, which they are often structured as business development companies or BDCs, have seen their stock prices absolutely plunge in recent months.
And we're talking about absolute financial giants here, like Blackstone and Morgan Stanley.
Yes, the biggest names in the game.
And they have actively had to cap investor withdrawals to prevent a run on their liquidity.
Wait, so they are literally locking the doors.
They're locking the doors.
They are telling billionaires and massive pension funds that they cannot have their own money back.
That is exactly what is happening. It's a classic bank run, but specifically tailored for the ultra-wealthy.
Wow.
Think about the psychology driving this. You're a high-net-worth investor, right? You see enterprise software stocks plummeting because of AI disruption.
Okay.
You read Goldman Sachs warning about private credit defaults. You see your own fund's mark-to-market value dropping. What is your immediate reaction?
You call your fund manager and demand your money out before the whole thing collapses.
Exactly.
Mm-hmm.
But the fund doesn't have a giant vault of cash just sitting around. That is the trap of illiquidity.
Right, that money is actively deployed. It's locked up in the bank accounts of those vulnerable software companies.
Yes. So when everyone rushes for the exit at the exact same time, the institution literally does not have the cash on hand to pay them.
So they put a cap on withdrawals.
Right. And a glaring example of this playing out right now is a firm called Blue Owl Capital, ticker symbol OWL. Their stock is down a staggering 39% year to date.
I mean, a 39% drop for a firm managing billions in credit is a massive red flag.
Huge red flag. And the details of that drop are even wilder. Blue Owl received such an overwhelming wave of redemption requests from their investors that they had to restrict them.
Just cut them off.
Yeah. But even to scrape together enough cash just to pay the investors they were allowing to leave, Blue Owl was forced to hold a massive fire sale.
Oh, wow.
They liquidated $1.4 billion in assets.
$1.4 billion. Let's unpack the mechanics of a fire sale, because this is where the contagion really accelerates.
Yeah, let's get into it.
It's like, imagine trying to sell a multi-million-dollar mansion in a single afternoon because you need to pay off a gambling debt by midnight.
You're definitely not getting top dollar for that.
No, you're going to have to take a massive loss just to convince someone to hand you the cash today.
Because selling at a deep discount lowers the overall value of the fund's remaining portfolio, right?
Yes, and when the remaining investors see the fund's value drop even further because of that fire sale, they panic even more.
So they immediately submit their own withdrawal requests.
Exactly. It's a self-fulfilling prophecy. The fear itself becomes the mechanism that destroys the market, forcing these illiquid funds to cannibalize their own portfolios just to survive the bank run.
Cannibalize your own portfolios. That's a terrifying thought. And contagion is the exact word keeping financial regulators awake at night right now.
Absolutely.
Because contagion never respects boundaries. If these multi-billion-dollar giants are restricting withdrawals and cannibalizing their assets, you really have to wonder what happens when this spills over the walls of the private credit market into the broader economy.
Well, the lens broadens significantly here. The underlying data suggests that if the private credit market crashes, there is a legitimate risk of another systemic financial crisis.
Really?
Yeah, drawing heavy comparisons to 2008.
Okay, I have to push back on that.
Fair enough.
Because throwing around 2008 is like the ultimate trump card in financial analysis. It immediately makes everyone panic and think of collapsing housing markets and massive taxpayer bailouts.
It definitely triggers a reaction.
So based on the mechanics we've just walked through, is comparing this to the 2008 financial crisis actually alarmist? Or is it a genuinely valid parallel?
It's a vital question because the trigger is completely different, right? This has nothing to do with subprime mortgages.
Right.
But the comparison is valid because it's about the structure of the financial plumbing.
Okay. How so?
In 2008, obscure illiquid assets, those toxic mortgage bonds, suddenly dropped in value. The crisis exploded because the traditional banks were holding those assets or lending against them.
Right, the banks were exposed.
Today, the obscure illiquid assets are private credit loans. And the International Monetary Fund, the IMF, has explicitly warned that traditional banks have massive exposure to this private credit space.
Wait, so the traditional banks, the ones where everyday people have their checking accounts, their savings, their mortgages, they are tethered to these shadow banking funds?
Yes. Traditional banks act as the leverage providers. They lend billions of dollars to the private credit funds so those funds can make even larger bets.
Oh, I see.
So if a private credit fund collapses under the weight of AI-disrupted software loans and billionaire bank runs, they default on their massive loans to the traditional banks.
The fallout jumps the wall.
Exactly. That is why the IMF is sounding the alarm. The contagion has a direct pipeline into the mainstream banking system.
That makes the macro picture incredibly precarious. especially because this private credit distress isn't just happening in a vacuum.
No, not at all.
It's colliding with a perfect storm of other global uncertainties.
And the convergence of risks is what turns a localized fire into a systemic threat. At the exact same time the private credit market is trembling over AI displacing software, the broader stock market is getting highly nervous about the AI boom itself.
Yeah, the hype is starting to crack a little.
Right. Investors are increasingly terrified that the hyperscalers, the massive tech giants like Microsoft, Google, and Amazon, are spending way too much money on building out AI data centers.
There's a growing fear they are pouring billions into infrastructure that won't actually generate a return.
Exactly.
The hype has vastly outpaced the actual revenue generation of these AI models. So you have this bizarre squeeze happening simultaneously.
A squeeze on both ends.
Right. Enterprise software valuations are plunging because they might be disrupted by AI. And the companies building the AI are facing a reckoning because they might be burning cash on a massive bubble.
Capital is threatening to dry up on both sides of the technology sector. And then you have to factor in the heavy macroeconomic and geopolitical stress amplifying all of this.
Yeah. It never rains, but it pours.
Right. We are looking at major escalations globally, specifically the war in Iran, and the resulting spikes in global oil prices.
Okay, but how does an oil spike thousands of miles away connect back to a private credit fund in New York struggling with software loans?
It's the final tightening of the noose.
Okay.
Energy costs dictate global inflation. Everything from shipping to manufacturing gets more expensive when oil spikes.
Right. Everything costs more to move.
Exactly. And if inflation stays high because of energy costs, central banks cannot lower interest rates.
Ah, I see where this is going.
Right. Remember those software companies holding massive private credit loans? They are trying to survive an AI disruption while paying exorbitant interest rates on their debt.
Because the rates stayed high.
Yes, the longer rates stay high due to geopolitical inflation, the faster those companies burn through their cash. And that accelerates the exact default cycle David Solomon warned about.
Wow. When you stack a shadow banking liquidity crisis on top of an energy crisis,
Yeah.
and then throw in a potential AI infrastructure bubble, it feels incredibly overwhelming.
It's a lot to process.
If you are listening to this right now, digesting all these converging risks, you are likely wondering how you are supposed to protect yourself. Like, how does a $1 trillion VIP room catching fire impact your own retirement account or brokerage app?
And this is where we really need to synthesize all of this systemic uncertainty into a practical, actionable strategy.
Yes, please, give us some good news.
Well, the overarching reality is that the market landscape is vastly more dangerous today than it was just a few quarters ago.
So the specific advice derived from analyzing all these converging risks is essentially twofold. Stay vigilant and be prepared for a pullback.
That's the baseline.
But I really want to frame this as an empowering takeaway for you. It is so easy to hear phrases like systemic risk or contagion and just panic or, bury your head in the sand.
Absolutely.
But understanding the plumbing actually gives you an edge.
It really does. The most practical recommendation for navigating this specific type of macro storm is to actively build your cash reserves.
And building cash is the perfect mindset shift. Rather than viewing a market dip as this purely destructive event that ruins your portfolio, having cash on the sidelines turns a potential crisis into a future buying opportunity.
Exactly. Think about the mechanics we just discussed.
Right.
When contagion fears cause share prices to fall across the board, the investors who panicked lose out.
They sell at the bottom.
Right. But the investors who prepared, who understood this AI domino effect and built up their cash reserves, they get to step in and scoop up valuable assets at heavily discounted prices.
It essentially turns fear into leverage.
It's all about maintaining optionality when the rest of the market is forced into a corner. When massive institutions like Blue Owl are forced to sell off billions in assets at a steep discount just to survive a bank run, you want to be the one with the cash.
Right. You want to be in a position to buy the mansion they are forced to sell in an afternoon.
Exactly, rather than being the one panicking alongside them.
Knowledge is the ultimate hedge against market panic. Understanding why the market might pull back, knowing that it's tied to this bizarre hidden domino effect between artificial intelligence and private credit, means you won't be blindsided if the velvet rope falls and the smoke hits the main floor.
That's exactly right. And as we wrap up this deep dive, there's one final lingering thought I really want to leave you with.
Really honest.
We've spent this time tracing how the rise of generative AI is causing panic and freezing assets in a seemingly unrelated, hidden world of private finance.
Right.
It was a structural vulnerability nobody was talking about until the cracks started showing.
Yeah, it was totally under the radar.
So this raises a vital question for you to explore as you evaluate your own investments. What other deeply entrenched, seemingly safe corners of the global economy are currently sitting on undiscovered AI fault lines?
Oh, that is a brilliant question. We just assume AI only disrupts software coders or customer service call centers. But this proves the rot can reach deep into the absolute bedrock of the financial plumbing.
Exactly. I invite you to consider what other traditional industries might secretly be built on foundations that artificial intelligence is quietly eroding right now.
Because the private credit market was just the first domino to wobble.
It won't be the last.
And when those other fault lines finally slip, you really don't want to be the one trapped inside the VIP room when the door is locked.
Definitely not.
Keep your eyes open, watch the underlying data, and build that cash. Thanks so much for joining us on this deep dive. We'll catch you next time.